Hey, welcome back. About to sit down with Jeff Bay for video number 2 of our series, bringing you information about mortgage financing. Here we go. All right, we are back. We're with Jeff Bay again. This is going to be segment 2. We're going to be talking about non-QM or bank statement program loans. So let's jump right in. I want you to, I'm excited about this because there are a lot of people out there that, have different scenarios where they may not just qualify. So why don't you walk us through a little bit about this, like non-QM? What does that even mean?
Yeah, so non-QM stands for non-qualified mortgage. So it's a non-traditional mortgage. With these type of loans, basically the borrower doesn't have to really show their ability to repay the loan. Typically with a traditional mortgage, you're showing you're showing tax returns, W-2s, pay stubs. This way the lender can gauge on whether or not you can, repay the loan. But non-QM is a little bit different, and there's actually a few different products, but we'll talk about bank statements for now. So the 12-month business bank statement or personal bank statement is for people that are self-employed. Now you have to be self-employed, to qualify for this type of loan.
Do you have to have like any kind of special do you have to have
so typically one of the requirements is going to be with the 12 months business or personal bank statements, they're going to want to see a letter from your CPA, basically stating that they have been doing your taxes for the past 2 years and they can acknowledge that you are self-employed or file as self-employed.
Yeah. So like me, I'm self-employed. I'm independent agent.
Yeah, this works great for realtors.
So
absolutely.
I just have to show 12 months of my bank statements. So they're looking for deposits. Do they go through and look at
so we actually, one of my investors will only take the first page of each bank statement for the past 12 months, and they'll just use the gross deposits from each statement. They'll add that up and divide it by half, and then that's considered your income. He's in the cigar business. He deposits roughly about $50,000 to $60,000 a month from his business, right? But at the end of the day, he writes a lot of that stuff off. So his net income on his tax returns doesn't show a lot.
Right.
So the alternative for us was to go
most business owners do.
Most business, yeah, exactly. And I do, you do, we all do, right?
Yeah.
So, and so the alternative was to go with the bank statement loan, right? To be able to qualify for what he wanted to purchase. In this case, his credit score is over 720, so the minimum down payment, and it's gotten a little bit, the guidelines have expanded lately, so we can do actually 10% down with a minimum 720 FICO score, up to 1.5 million.
Okay.
And I can do 20% down up to 3 million.
Okay. So for my market, that's probably more of a loan that we'll use or see more frequently, because, that's like $2-3 million clients is usually what we're seeing.
Yeah, and at the end of the day, the rates aren't that much more. So the more you put down, obviously, the better the rate is. But if you're looking to put 20% down up to 3 million, you're probably going to have a rate in the 4s, which isn't bad at all. And you have the option if you want to go interest only or if you want to pay principal and interest. So.
Yeah, because like a traditional 30-year mortgage right now is what, 3.5%?
Yeah, so 3.25% on a conforming loan. A jumbo loan's probably in the mid to high 3s right now.
So you're talking about maybe this is 50 basis points more?
Yeah, it's not a whole lot more. In fact, just another example, I did a deal in Laguna Beach. We're actually in the process right now. We just got approved. My client paid $1.7 million for it 12 months ago. We did a bank statement loan. He got a rate of 6.125%. This was last December.
Okay.
And since then, so he's actually built so we just had it appraised at 2.2 million. So he made $500,000 in equity. Our LTV, our loan to value, is now at 65%. And we're doing the same type of loan. The interest rate's 3.875.
Okay.
Yeah. So it's right there with a prime jumbo loan. So.
It's awesome. This is, in our first video, we talked about, using some of these, non-traditional financing tools to just get a property that you want. This is actually kind of, not as complicated, but similar kind of, thought process is that, if you're a small business owner and you don't qualify for, the traditional loans and you still want to buy a house, so that person in Laguna Beach, they, what, the rate was a little bit higher for a year, but it
was worth it.
Yeah, the equity in the house.
Yeah,
it's not going to always work out that way. We're, a lot of people think we're kind of approaching the top of the market, so that equity growth might slow down a little bit, but I think that it's great. So, okay, so 12 months bank statements, letter from your CPA, 720 FICO.
We can go as low as a 640 FICO, just but the lower the credit score, the more the down payment. Yeah.
More the down payment, and the more it's going to cost you.
Right, exactly. Yeah, higher rate.
It makes sense.
And just to kind of add on this, we even offer now 1 year P&Ls. So if the bank statements can't quite paint the picture, we'll accept a 1-year profit and loss statement from your CPA or an enrolled agent.
Okay.
As income.
Okay.
And so I've done a ton of these deals as well too.
Okay.
So.
Interesting. Yeah. All right. So, I mean, how you need 30, 45 days, 60 days? Like what?
We're closing them in like 25, 35 days. So yeah, typical escrow period, 30 days, easily.
Easily?
Yeah.
Okay.
Easily.
Okay. I mean, anything else that, the average investor or average buyer should be thinking about?
I mean, look,
sorry to interrupt you, but like always, well, you don't ever want to open a new account, right? Like I've seen this where you have two physicians and the wife was at Saks and was like, oh, I just opened an account, and husband's like, we're trying to get a loan, I
think right now the most important thing, which is what we're kind of seeing, because the market, there's not much inventory, and if you're getting pre-qualified with me today to buy a house, odds are you're not going to find a place and close escrow within 30 or 60 days because there's just so much competition out there, right? Multiple offers, especially that 1 to $2.5 million price point. There's a ton of buyers for that price point, right?
Yeah.
So I think the biggest thing is, and if you're going to go with like a non-qualified mortgage, like the one that we're talking about, credit score is important, because if your score is 740 today, right, and credit reports are typically good for 120 days with the lender, but it takes you 2, 3, 4 months to find the property. That credit score that I approved you with, may not be the same creded score, 3, 4 months.
You're going to run it again.
We're going to run it again. It's going to expire. So the reason why I point this out is because certain credit scores have certain, so for instance, a 740 FICO score may only require 3 months reserves, right, for the loan. Mm-hmm. Reserves meaning that you have to have 3 months of the total payment, including taxes and insurance, in your bank account. But if your score drops to say 700, that reserve requirement may go up to 6 months or 9 months. So if you barely qualify with that amount of money in your bank, today, and your score drops in 3 months, and you find a house and you're in escrow, you may not qualify then. Yeah.
So, I mean, you really want to be mindful, and you should always be watching your credit score. Mm-hmm. And sometimes it's not a matter of even opening a new account. Mm-hmm. It can be carrying a little bit of a higher balance. Your utility rate, what's it called? The utilization rate?
Correct.
Right?
Correct.
Yeah. You want to keep it below 3%?
Yeah, you want to keep it below 50, well 30% ideally, but I mean, you want to kind of keep things where they're at when you first run your credit,
right,
when you're in the process of buying a house.
Right. Yeah. Don't buy a card, don't charge up your cards, don't open new cards, don't be late. I mean, late's all sound like, common sense things, but people, we're living busy lives and things happen, but you got to be on top of that kind of stuff.
I bring it up now because when you're finding a property within 30 days and closing within 60 days, it really doesn't matter. You can kind of use your cards. We're not going to pull up another credit report. Yeah. But because buyers are taking so much longer to find houses and to close deals, this whole 120-day expiration of a credit report comes into play now.
It's interesting. I always try and tell people, especially younger people that are looking for kind of those entry-level homes and they're bidding against a lot of people in this market, get fully underwritten, get fully credit approved, right, so that you can make virtually a cash offer, right? Because I don't know why more people don't do that.
Yeah, for non-QM, no, we typically can't fully underwrite the file, but I mean, we have a good sense of whether the file is gonna move forward or not. Like I typically, I'll be honest, every single deal I did last year, we closed every single deal. So, there wasn't a deal where we didn't properly qualify the person ahead of time.
Yeah.
If we lost a deal, it was because of the client. Maybe something changed in their financial profile. Yeah. At the close, but
okay. Well, I mean, this is great information. I think that there are different types of buyers out there right now. We talked about in our first video together, private money, kind of real unique type stuff. This balance sheet, or I'm sorry, bank statement, non-QM, like this is another one. This is great for a certain set of people. On our next one, what should we talk about? You want to talk about
so the one that I'm doing a lot of right now is so we can talk about DSCR, which is typically for investors. It's a debt service coverage ratio loan. So it'll allow an investor to purchase an investment property with no income, no employment. The qualifications solely based off the property, what it'll rent for.
Oh wow!
So that's a good product too. Rates on the fours, you can put down as little as 15% down. I'll share with you a case study. I had a client that we pulled cash out of 2 of his properties in November, and we bought 3 houses in December. Wow! So we pulled $1 million out. We bought 2.3, 1.8, 1.5. And it's a 5-pack. We closed it, in 45 days. So, and then there's also no ratio. So for like a primary, someone looking to buy a primary residence, we can do, again, no income, no employment, as little as 15% down. We'd structure that like in a first and second, 80% first, 5% second. Rates are in the 5s, and we can go up to $3.5 million. So.
All right, cool.
Yeah.
All right, awesome.
A lot of interesting stuff, actually.
Cool.
Yeah.
All right, man. Well, thanks
Cool.
again
Thanks,
for all
Rob.
your time.
Appreciate it.
Okay. All right, that's a wrap. So video 2 with Jeff Bay, independent mortgage broker. We talked about bank statement program loans. So we want to bring information about how to acquire properties, what it means, what type of products there are. So next time we are going to talk about different products that can help people in all different circumstances. But mostly what we're talking about is traditional bank financing. So it's pretty fun, interesting stuff. Don't forget, like, subscribe, comment below, and we'll see you on the next one.